Hello, Business 630. This is Mr. Hassey. It's week number 4 weekend update video concentrating on the cost of capital and capital budgeting analysis. I'm going to refer to that spreadsheet that I introduced in my intro video for week 4. And we're going to review that today because it's a very good template for your case number 2 capital budget analysis in that spreadsheet that I gave you. Also, we'll be moving forward into this in week 5. We're going to be talking about in our lecture video on Monday evening, which then will be posted on Monday, May 1st. We'll be talking about the second part of capital budgeting analysis, risk analysis, which is the final tab of that spreadsheet. So let's take a look at that. Okay, this second third of the course, by the way, this completes week 4, completes the halfway mark of our class. And as I indicated in my original video of this week, please, if you have any questions or concerns about the halfway point, if things aren't working out for you or you're not pleased with the course, please feel free to let me know and we can talk about it. I had one student try to contact me Thursday evening for student hours. I was not available to you, and I think matter of fact, I know I indicated that, and I apologize for the student who came on and I was not there. But again, I'm available anytime during the day and weekend. So if you really need to get a hold of me, please do so. So again, we're talking about in this second third of our class, or this second of 3 thirds of the class, capital budgeting analysis, which is to determine whether an investment in an asset is going to give you adequate enough return to legitimize that investment. And that's what we're doing here in this part of the course. It's called capital budgeting. In order to do that, we need to follow a variety of steps. In this spreadsheet that I gave you, of which also the solutions are posted in week number 4, you have to do 3 segments, and that's 3 segments that you're going to also do in the case number 2, which is due a week from Sunday, May 7th. You have to do a cost of capital. What is the cost of the money that they're getting? Then you do the budget analysis, the investment return analysis, determining the cash flow and the investment return. We're going to be doing that in this weekend update video. Then at the same time, the last part, which we'll do in our next segment, is we have to do a risk analysis, which is a risk analysis of checking the numbers, making sure they're legitimate. One is called a scenario analysis, and the other is a sensitivity analysis. This is called risk analysis. And we'll be looking at that in our week 5 video on Monday, May 1st. So let's do a capital budget analysis. In other words, what is the cost of money at a given day at the beginning of this analysis? Remember, companies, corporations, large, small corporate companies do this analysis to make sure before they commit to the funds, commit to the investment, whether this looks pretty good to do. And the first step is to determine the cost of capital. This is one of the things I ask you to do in case number 1. Speaking of case number 1, I have now received all the casework from all of our students, and I will be posting those solutions and talking about case number 1 review in my week 5 lecture. I apologize it's taken so long, over a week, to get back to you, but I was giving some students who are traveling and out of town the opportunity to get their work in, and I'd rather not post the solutions or the grades until all the cases are posted. They now are, so I'm going to be posting those grades and discussing them in our Monday, May 1st video. So that's where that stands. So first of all, we have to determine what's the capital structure of the company? What percent of the company is financed by debt? What percent of the company is financed by equity? Remember the balance sheet equation of assets equals debt or liabilities plus equity. Well, in this example here, debt to assets are 60%. So if debt to assets are 60%, that means equity has to be 40% of the capital structure. It has to equal 100, just like the accounting equation here. Assets equals debt plus equity. Debt and equity have to equal assets. So that's why it has to be 100%. The next part is, what is our cost of debt after taxes? Remember, corporations get a tax shield off their interest expense due to the tax rate of the company. So in this example here, we're assuming that this 60% debt is costing a company 9% interest. So their actual after-tax cost of debt would be the 9% interest times 1 minus the tax rate of 30%. See what I did here? 9% times 1 minus 30%. In other words, 9% times 70%. That equals our after-tax cost of debt, which is 6.3%. So yes, the company is spending and writing payments on that debt to the creditors of 9%, but they get to deduct 30% of that on their tax returns, corporate deductions. So their true after-tax debt is taking out the taxes, 6.3%. So now if I put 6.3% down here as the interest or the cost of debt, it will now weight that 6.3 times the capital structure percentage of debt, 60%, and I get 3.78%, which is the weighted average cost of debt after taxes. The cost of equity is the capital asset pricing model. Remember the cost of capital asset pricing model, we also looked at this in case number 1, takes the risk-free interest rate of 3.75, the market premium of 9%, and then takes that market premium times the firm's beta of 1.25. So equals risk-free rate 0.0375 plus the market premium of 0.09 times 1.25, and I get 15%. So in 3.75 plus 9% times 1.25, the beta or the risk of the company equals 15% cost of equity. So 15% as our cost of equity, and I weight that 15% by the capital structure percentage of 40%, I get 6%. Add the two together, the after-tax weighted average cost of debt of 3.75 plus the cost of equity via the capital asset pricing model, the expected return investors expect to receive, weighted by the equity position of the company, equals 9.78%. So now I will put that 9.78% right here as a variable in my capital budget analysis, because that's my discount rate. That's my cost of capital, which will be included in this calculation. So now I have to take all these variables, the investment, salvage value, depreciation, units sold, all selling price, inflation rates, variable cost, fixed cost, project tax rate, and the working capital rate, put these all together into a cash flow estimate of this investment. So let's do that. Many of you have done this prior in other finance classes. If you have not, now's the time to really pay attention, because this is a key part. We're going to be doing this in case number 2. You're also going to be doing this next weekend when I post our course assessment case paper, which is due on May 28th. So here's our investment. We're spending $1 million in year 0. Notice I have a lot of the formulas already set up in this template, which makes it nice and convenient for you to review. So again, today is year 0. We're investing $1 million. We're also going to have a salvage value of $50,000 in year 10. So let's put that there. In other words, we're going to be selling this investment at $50,000 and receiving $50,000 in cash at the end of year 10. But are we going to receive $50,000 in cash at the year 10? Let's take a look at that in just a minute. Our depreciation is $100,000 a year. Everybody should know about depreciation. It's a accounting entry to not spending any cash, but to expense and reduce tax liability by having an additional expense for writing off the value of the asset. In this case, it's $1 million investment over a 10-year depreciable life. That means we're depreciating $100,000 a year. And as you can see, the full year is a full $1 million is depreciated. And now we are and also we add back that 100,000 down here as additional cash flow because it's a non-cash expense. Remember, depreciation is an accounting entry. You're not spending any money. You're allowed to do that by accounting laws and laws of taxation, but it's technically cash flow. You add it back, and that's what we're doing down here. Now, because of that, notice we're depreciating $1 million. So our book value of this asset, meaning the value of the asset on our accounting books, is zero at the end of its depreciable life, meaning this $50,000 cash we're receiving as the salvage value in this asset is a gain on the disposal or the gain on the sale of the asset in year 10. We got to pay tax on it. So let's just adjust this 50,000 by taking out the taxes. Equals 50,000 times 1 minus the tax rate. So we're really only going to get 70% of our 50,000 because we got to pay tax on that gain. So we're actually receiving $35,000 net cash flow for the disposal value of the asset at the end of 10 years. Now, again, remember, this is a budget. This is an estimate. This is a plan by a company. It's a template. It's a model. Doesn't mean we're going to get $50,000 for it, but when we purchased this asset and invested in it, maybe the purchasing agent found out that from the vendor, what's this value of this asset after you beat the hell out of it for 10 years, its depreciable life, and they say, well, we estimate it to be $50,000. So we put that into our template. Now, our units sold every year is 25,000. So we anticipate selling 25,000 units every year over this life of this investment at a selling price in the first year of $20. So if I go to year 1 and I put in 25,000 times the $20 selling price, there's my revenue of $500,000 in year 1. Okay. Now they tell me that's going to inflate annual change in sale price after year 1 is 2.5%. So this is going to be inflated every year at 2.5%. So now I'm going to put a formula here equals that 500,000 times 1.025, an additional 2.5%. Now I'll just copy that and slide it all the way to year 10. And there's my total sales figure anticipated for this project. 25,000 units at $20 a unit selling price, inflated at 2.5% after year 1, $5,602 million of anticipated sales revenue. What is my variable costs? All right, my variable costs are per unit, $8 a unit. These are maybe you're putting the wages, marketing, whatever. Variable costs are $8 a unit. So now I'm going to put in 25,000 units times $8. So there's my expense, my operating expense for variable costs, $200,000. This also inflates at 2% a year. So now I'm going to make that 200,000 increase by 2%, 1.02, and slide that and increase that 2% every year. And there's my total variable costs of $2,190,000. My fixed costs do not change per unit, but are a flat expense every year, like insurance, like salaries, whatever, rent. $50,000. One flat amount, $50,000 per year. But like every other type of expense, this is going to inflate as well. Notice the annual change in fixed cost is 1% a year. So now I'm going to take that 50,000 and inflate it by 1%, 1.01, and that'll inflate every year. And there we go, $523,000 of fixed expenses. So look what we've done. We've taken the variables that we've been given, we've inflated it based on the information given us, and we now determined our earnings before taxes is $1.889 million. Sales minus variable costs, minus fixed costs, minus depreciation, and there's the formula right there. That earnings before taxes is now going to have a 30% tax rate. So I'll take 30% of 150,000, 158, and so on. And I get my net accounting income, 105,000 in year one, and so on. Total net income of $1,322,000. So we're projecting a $1 million investment with a depreciable life of 10 years and these planned costs. Now remember, all this information is coming to the financial managers or the financial analysts of this company. You're getting information from the marketing people about what you anticipate sales to be every year and the price. From the accounting people, you're getting what's the inflation rate for these variable costs or revenues. You're getting all this information and you're putting it together to determine cash flow. And there's our net income. But that's not the cash flow. Net income is accounting income. This is what you tell the IRS. This is what you show on your income statement. But your true cash that you're receiving from this is a combination of multiple things. First of all, there's the depreciation being added back in. Then we have, as we did earlier, the net cash flow received after the disposal of the asset. Now, again, in the real world, you might not dispose of it at the end of year 10. You might just keep this equipment and keep doing it. Year 11, 12, 13. But for financial analysis, it's based on the depreciable life. That's how much, that's because you're getting cash flow, $100,000 every year during the depreciable life. At the end of the depreciable life, no more cash flow from depreciation. The asset is fully depreciated. So technically, financially, this project is over. Another key area of this cash flow, besides salvage and depreciation, is called net working capital. In other words, the investment of $1 million also necessitates an investment in inventory, in payables, in operating assets and operating liabilities, current assets, current liabilities. That requires upfront money. I'll give you an example of that. If you went and bought a car, let's say for $50,000, and you purchased the car, borrowed the money, bought the car, took it home. Now, is that going to be the ending of your expenses for that car forever? No. Every year you got to put money into insurance, gasoline, maintenance, all kinds of things. Those are additional expenses from the car. Well, if the car is generating revenue for you, you're using it like for work, you get to write off all those expenses on your taxes. But at the same time, you need money to pay for all those those expenses up front, and that's called working capital. So in these capital budget problems, either your CPA firm or your internal cost accountants of your company will determine a working capital rate. In this case, the working capital rate is 12% of the next year's sales. So look what I've done. In year 0, I've taken 12% of 500,000 and got $60,000. That's additional cash you need to invest in the asset to get it operating. So our true net cash flow in this investment is not only the $1 million of what it's costing us to buy the investment, the equipment or whatever it is, plus the additional $60,000 of working capital required to get the project operating. So $1,060,000 is our net cash flow up front. Now, every year you're going to be doing additional working capital based on the next year's. In other words, year 0 takes year 1. Year 1 takes year 2. But notice in the formula, it's not 12% of 512,500. It's 12% of the delta between year 2 and year 1 sales. That's $12,500. So notice my formula here. It's taking year 2 sales minus year 1 times 12% rate, 1,500. So remember, this is working capital. This is not expenses. This is asset and liability. So it's an ongoing amount. So after the year 0 and year 1, we've accumulated $61,500 of working capital, negative cash going out. Notice what's 12% of $512,500. It's $61,500. So you do this every year through year 9, taking the difference between the next year's sales and the current year's sales and multiplying it by 12%. And notice at the end of year 9, we've accumulated $74,932 of negative cash flow to cover working capital. Then in year 10, there's no year 11 to determine a new working capital base. The project, financially speaking, is over. So now all this accumulated negative cash is going to be added back in year 10. In other words, you take 12% of $62,431, you get $74,932. The net effect of all this is 0. So in terms of the entire project, cash flow wise, it's a wash, but you're showing the need for negative cash in the years for working capital. And then when the project is over, all that working capital comes back into the project. The net effect is nothing, but you're showing the hit in the early years of the negative cash to provide the necessary working capital. A little bit confusing, but a key ingredient in capital budgeting analysis. So we now can determine our total cash flow. It's in year 0, the investment plus working capital, negative $1,060,000. In year 1, it's the net income plus depreciation minus that working capital, $203,500. And notice every year, there's our net cash flows generated each year. And notice in year 10, it's a little bit higher because of the salvage value after taxes and the paying back of the working capital as positive cash flow into the investment analysis. So now $1,060,000 is generating $2.417 million of cash. Looks like a pretty good investment. Well, let's take a look at what this investment return is in dollars, in a percentage, in a ratio, and in years. First of all, we have to determine, and this is where that project WACC that we talked about earlier comes into context. We have to determine the discounted cash flow of $2.417 million discounted back to year 0. Formula, function, financial, NPV. We've looked at this a little bit before. NPV. So our rate is our weighted average cost of capital that we calculated in the first tab, 0.0978. And we're going to discount the accumulated values from year 1 through year 10. F21 to O21. We're taking each of those 10 years cash flow, discounting it at 9.78%, and we get our discounted cash flow. $1,444,719. So really, the $2.4 million in cash flow being generated off this investment is actually worth today, 10 years back, $1,444,000, because we're taking into account the cost of the money. So our net present value, our return in dollars, is the difference between the discounted cash flow and the net cash flow. We're making $384,719 in today's dollars on this investment. Now, what is that in a percent? Formula, function, financial, internal rate of return, IRR. It's the percentage return of the cash flows. And here, all we have to do under values is paint. And now in this one, we include year 0 to year 10. So now we're taking that cash going out, cash coming in. What is the percentage return? 17.03% return on this investment over the depreciable life. Okay, 17.03, which is substantially higher than our cost of capital, and it's showing a good return, like just dollars is a good return. What's our profitability index? It's the return in a ratio. What's that ratio? The ratio of discounted cash flow to the net cost of the investment. So we just type that in, equals discounted cash flow divided by negative 1,160. 1.36. I put a negative in front of the 1,060,000 to make that a positive number. So it's giving us a positive ratio of 1.36 times. We're making a growth over the cost of a ratio of 1.36 times. What is this in payback? How many years to pay back the 1,060,000 in cash flow? Well, let's figure that out. First of all, we're paying out $1,060,000, and in the first year, we're generating, we're generating 2,035. So at the end of the first year, we still have $856,500 to pay back. Then we take $856,500 and add to it year 2 cash flow, positive, and we still have that to pay back. And then so on going forward. Notice at the end of year 4, we still have $211,987 to pay back. And then in year 5, we've paid it back. At the end of year 5, we've accumulated $1,074,730 on an investment of $160,000. So how many years is that? 1, 2, 3, 4, plus a portion of the 5th year. How much of a portion? Well, remember, at the end of year 4, we had still to pay back $211,987. So what portion of year 5, when we pay it back the amount of money? Well, what percent is $211,987 of $226,717? Well, let's do that. Equals negative divided by 226.17. We get 94%. So 94% of the 5th year to pay back the balance of the $1,060,000. So 1, 2, 3, 4.94 years. That's 94%. And there's our payback. So now we've looked at this analysis. I'm going to save this. Now we've looked at this analysis and we've determined in dollars, 384,719 profit or net cash flow, percentage 17.03%, ratio 1.36 times greater than the investment, and payback a little bit under 5 years to pay back the $1,060,000. There's our analysis. On the whole, this looks like a solid investment. Now, the company might want to return more then they'll have to take a look at this. But as far as just returning your investment, you're making money on this in dollars, percent, ratio, and payback. This is what you have to do in case number 2, this analysis of the variables given to you. Now remember, make sure you have the right inflation rate. This is the inflation rate for these variables for this project. But maybe in the variables for case number 2, it's a different one. So when you're doing the templates and doing the analysis, doing the arithmetic, make sure you have all your variables properly incorporated in your analysis. Every project is different everywhere. The WACC's going to be different based on the company. The inflation rate's going to be different. The fixed costs are going to be different. So and even the working capital rate and maybe even the tax rate. So you have to make sure when you're incorporating this into another problem, you have the correct variables. And that's where it requires you to pay attention to the information given to you in case number 2. So I will post this to week 4 and 5 solutions in class review. In my week 5 introduction video, we'll be doing this tab here, taking this information that we just calculated and determining what if we only sell 12,500 units a year? What if we sell 35,000 units a year? How will that change our profitability via an NPV? And what will that look like under these different sales scenarios? And also, if we use the base analysis, which we just did of 25,000 units sold per year, what if we alter the selling price per unit? What if we alter the variable cost per unit? What if we alter the fixed costs by certain percentages? How will that affect profitability? And we'll create that in a chart here to show us how variables change due to the change in their sensitivities. What if we lower selling price by 15%? What if we increase selling price by 15%? How will that affect profitability? So we're going to take a look at that in our week 5 video. You also have to do this in your case number 2. So basically, case number 2 is putting together, based on the variables you're given, an analysis of what their cost of money is, which will be the discount rate in your capital budget analysis by taking a series of variables, putting into a spreadsheet based on the depreciable life of those variables, and coming up with this return analysis to tell me your interpretation whether this is a good project or not. And in case number 2, all you have to do to tell me is just yes or no. In our course assessment case, which we'll talk about at the end of week 5, you have to write a paper explaining this analysis. So that's where we stand as we complete week 4. Try on practicing the blank one that I gave you, and I'll show you that where all that is in just a minute, and see if your numbers match mine in doing the arithmetic. So we're now back at our Blackboard. If you go to week 4, which is the end of this week, and you go to lecture video spreadsheet analysis, there's the original spreadsheet of this work that I posted, all blank, and that's a good one to practice on. And here's what this is the file, this is the file, hit the wrong button. This is the file we just worked on with the solutions for the weighted average cost of capital and the risk and the base analysis. We'll update this with the risk analysis in our week 5 video. So you can download this and use practice if you'd like, and use this as a solutions or template going forward to set up your case number 2. But remember, case number 2, you do it on the spreadsheet that I provided. Okay, don't forget that. And I'll talk more about that in our lecture video on Monday for week 5. So that's where we stand right now for week 4. A good start to capital budget analysis. I know a lot of you have done this before. Many of you have not, or it's been a long time. A key study of corporate finance and financial management is to get a handle on asset investment, get a handle on how to calculate return on investment, and understand how to determine net cash flow for any type of investment in asset. You can even do this to figure out whether you should buy a new home or a new car, but that's personal finance. So everybody, thank you. Look for your week case number 1 grades at the beginning of week 5, and I'll see you all in week 5 introductory lecture Monday evening. Thanks, everybody. Talk to you then. Bye-bye.